1 minute with Mitch.
Hello, everyone. It is August 7th, Wednesday, 2024. This past Monday, we had a big market drop, only the second of 2024. The last one we had was in April, and we saw lots and lots of volatility. Big news came out last week, and the Fed had their meeting, and there was job numbers were lower than expected. New jobs created were lower than expected. The data coming out showing manufacturing was lower than expected. The Fed met Wednesday and Thursday of last week and then decided that they were not going to do anything with the rates. They were going to continue to hold the rates steady. And then that was announced on Thursday, and then Friday, some jobs numbers came out. We only added 125,000 new jobs. Most people expected 150,000 new jobs. And you can remember if we went back 7, 8, 9 months ago, we were adding a couple of 200,000 jobs. So things have slowed down. If you remember, the Fed took 16 rate hikes. They increased interest rates 16 times. And that was all in hopes of slowing the economy down, slowing the job creation down, and hopefully lowering inflation. Inflation did hit a high of 9.1% and is now back to somewhere around 3%. But over the last couple of months, May and June, according to Bloomberg.com, the markets and economy was starting to slow down a lot. We were seeing those cracks happen. As I said, last Thursday, August 1st, the Fed decided to leave things alone, even though they saw the data showing down trends, economy starting to slow down and crack. But that's what they expected. That's what they tried to do. That's why they had those 16 rate increases. However, as you know, there is a rest of the world, and the rest of the world sees the same thing. They've seen inflation. They all follow the U.S. They see what the Fed does here. And in Japan, the Fed raised rates. Over in Japan, they've had almost zero interest rates for many years. And they saw what happened in the U.S., and they were very concerned about that. Now, Japan is way ahead of us time zone wise. So when our numbers and things came out on Friday, they were already closed. Now, this past Monday, Japan actually opened up the day before, which was their Monday because of the time zone change. And they opened up, and the Nikkei 225 average dropped 12%. And when the U.S. saw that on Monday morning, we saw that happened in Japan, and we had major drops. I think the S&P was down about 3.5%. The Dow was down about a little over 1,000 points. The NASDAQ was close to down 1,000 points. Came down back up during the day a little. I mean, it went from 1,000 to about 600 points down. Same thing with the NASDAQ and the S&P. They did have some recovery, but by the time it was over, we saw some big drops on Monday, August 5th. And a lot of that had to do with the Fed not dropping rates yet. The Fed has been known to raise rates too late to slow down inflation, and then they've also been known to cut rates too late, because then they overdo it. So that's what really has spooked a lot of people is, did the Fed wait too long? Now there are calls for possibly a 0.5% drop in the interest rates at their September meeting. They're off, they go on vacation in August, there are no meetings going on. So we're about 7 weeks away from the next Fed meeting and an announcement on what they're going to do with rates. Some people have actually been calling for a special meeting to lower rates, but I think things have calmed down. Tuesday, August 6th, we saw the markets come up a little. We had a nice slight gain in the morning. I don't know what the close was yet, but we'll see. But again, we didn't have another sharp drop on Tuesday, August 6th. We'll see where that winds up soon. On Monday, August 5th, the VIX saw, during that major sell-off, the VIX, which is the volatility index, reached its highest level since the early days of COVID-19, which happened in almost 4 years ago. Treasury yields also, that was the big thing. Treasury yields plummeted. They actually plummeted a lot. The 10-year Treasury today, well, actually August 6th, is 3.86%. These numbers I'm going to quote are according to Bloomberg.com as of August 6, 2024. The 10-year Treasury dropped down to 3.86. Over the last 1 month, the last 30 days, that is a 42% decline in the percentage of where the 10-year Treasury yield was to where it is today. You've heard me talk about over the last 2 years the inverted yield curve. That is going away rapidly. That's where the 3-month, 6-month, and 1-year Treasury bills were much higher than the 10-year. And what's happened now is over the last couple of days, the 3-month Treasury bill has dropped now down to 5.19%. It seems still pretty good, it is, but it was much higher than that. As a matter of fact, over the last 30 days, that has dropped 18.51%. The bigger drops are in the 6-month Treasury bill and the 1 year. The 6-month Treasury bill is now at 4.92, and that is a 36.08% drop percentage-wise from where it was just 30 days ago. And even bigger is the 1 year, which has now dropped to 4.49. Still a pretty good number, but they were well over 5%. That percentage-wise is 53.39%. So the Treasury bills have dropped, and which actually would be good. Hopefully that's all in anticipation of the Fed dropping as well. Yahoo Finance said the global market is in the midst of a rapidly intensifying sell-off after Friday's lackluster jobs report. Of note, though, almost 100% of bets are on the central bank cutting rates by 0.5%, and that's according to the CME Fed Watch tool. The U.S. job market is headed into its quieter week this week of data and earnings. The job market still is in focus. Weekly unemployment claims will be due again Thursday. That will take a bigger spotlight than usual, of course. The Fed raised rates, and hope was we need bad news, and that'll help lower inflation. Be careful what you wish for, because the Fed has now decided, and investors have now decided, that bad economic news is just plain old bad news. If you remember, I've talked for many, many months about it's counterintuitive. We want the economy to slow down. We want to see that crack, because good news will help the Fed lower rates and the stock market will go up. Well, we've come to that point right now, and that point is we are seeing the bad news with the 16 cuts, and now most people have said this bad news is really bad news, and the stock market reacted. Like I said, I don't have the closing numbers yet for Tuesday, August 6th, but we did see a turnaround off of yesterday's or Monday, August 6th, big drop. The Nikkei was down 12%, according to Bloomberg.com on Monday the 5th. However, on Tuesday, the 6th of August, according to Bloomberg.com, the Nikkei came right back. They closed up 10.23%. So you can see it was a quick knee-jerk reaction, and it came back up 10.23%. Not quite even, but that was a big rebound and a big rally. What I look at and tell everyone is diversification, diversification, diversification. We've got to make sure we're diversified. Don't take too many bets on certain sectors. The Magnificent Seven have been magnificent. That's why they got the name in 2023, and they were magnificent most of this year, probably up until July. But they are seeing some big hits. They've taken a lot of hits over the last few weeks, and really took some big hits yesterday. So again, diversify all the different sectors. We are analyzing all of the data and information. We're looking again at managed volatility. They've weathered the storm well. We're looking at value for this year as well now, because as interest rates drop, value stocks tend to have higher dividends. So a combination of possible slight growth on dividend stocks with dividends on these value stocks are probably another good sector to take a look at. I'm doing a lot of evaluations, but I think things are starting to calm down a little. People are looking at it, analyzing what's happened. It was a big drop yesterday. It's scary for a lot of people. It's scary for most people. But what we'll do is continue to look at this, evaluate it, and we'll get in touch with you about any changes that need to be made, or maybe not. Because again, diversification has paid off. We don't overload into one sector, because it does get very scary when you do that when things go bad. When things are great, everything's good and everybody's happy. But the market does go up and down a lot. In addition, on one final note, the stock markets, S&P, Dow, NASDAQ, typically, according to firsttrust.com, typically have 3 5% or more drops in 1 year. That is typical. 3 5% or more drops in 1 year, according to firsttrust.com. We have only had one. That was in April of this year. So this wasn't really that unexpected. But again, you don't know when the market can quickly turn around, when it can drop. So we're going to watch this and make sure we're allocated where we are, and continue to make sure you're diversified. Again, if you have questions, please call me. And thank you again very much. I just wanted to let you know and put out this special report. Thanks again.
1 minute with Mitch.